Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing ASE Technology stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. ASE Technology Holding is jointly established by the combination of Advanced Semiconductor Engineering and Siliconware Precision Industries. The company is headquartered in Taiwan and was founded in 1984. It went public in 2000 and currently trades on the NASDAQ. The company is a provider of independent semiconductor assembling and test manufacturing services. It is the largest outsourced semiconductor assembly and test provider with a 19% market share. Let's get started with the model. This is a large cap company. 16 billion market cap. They're trading at $7.55 a share and they have 2.1 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has positive free cash flow each year, fairly consistent from 800 million down to 630 million. Net income is the profit and loss on the income statement. That's revenue minus expenses. That's also pretty consistent from 820 million to 1 billion. Revenue is the sales for the company, and that grows a lot each year from 10.5 billion to 17 billion. This is the company's income statement. All the numbers are in Taiwan dollars. I converted them to US dollars on my Excel spreadsheet. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference is the gross profit. And their gross profit grows nicely each year. Below that is operating expenses and then operating income. When you look at the income statement, focus on operating income, because the stuff below operating income is not part of their operational business. And some of the items, especially in other income and expenses, are non-recurring. Below that is the interest they pay in their debt, and that seems to be lower than 2019, which is good. Below that is other income and expenses, which is usually impairments or other non-operational gains and losses. Then you have your pre-tax income, then your taxes. And the bottom line of the income statement is your net income. And that's the highest in 2020. The reason the net income is so high in 2018 relative to 2019, in 2018, they had so much in other income and expenses that brought up their net income. That's why I say focus on operating income. That's a better indicator of a company's financial health. This is their statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. This company has a lot of CapEx. Operating cash flow minus CapEx gives you your free cash flow. Free cash flow is the cash that's remaining to pay a dividend, grow the business, pay down debt, or to buy back stock. They do pay a dividend, but it looks like they're using a lot of their free cash flow to grow the business. They issued 10 billion of capital stock in 2017. They also issued a lot of debt in 2018. They paid down more debt than they issued in 2017, and they issued a little more debt than they paid down in 2019. Let's look at the capital structure. $8 billion of equity, $10 billion of debt. They're 44% equity, 56% debt. Their net debt is $8 billion, and their WACC is 8%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 24 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $21 billion. We divide that by 2.1 billion shares. And we get a calculated stock price of $10. They're trading at $7.55, so they're trading at a 25% discount. It's a buy according to the model. Simply Wall Street values the company at $16, so they're saying it's even more undervalued than me. This is the stock price the last 5 years. It looks like it hit $7 back in the beginning of 2018, but then it kept dropping. But for the past month or two, the stock price has really been driven up. It has retreated a little bit. This company pays an annual dividend, and their dividend payment is very volatile. It's up and down. They currently pay a 1.8% dividend yield. They pay out 29% of their net income and 46% of their free cash flow. They have a beta of 1.32, so the stock is a little more volatile than the market. The stock has gone up 58% in the past 52 weeks, while the S&P 500 went up 26%. The 52-week low was $3.17, the high was $9. The stock is trading above its 200-day moving average, but below its 50-day moving average. About 2.5 to 4 million shares are traded each day on this stock. Of the 2.1 billion shares outstanding, half of them are on float, 4% are held by institutions, and only 1/4% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you would have been on a roller coaster, down, then up, then down, then up, then down. But lately, your $10,000 went way up to $18,000. That's a 6% annual return if you held out through the ups and downs. The CEO of the company owns 22% of the stock, then another individual owns 16%, then Value Investing, someone else connected to the company owns 3%. Last is Vanguard at 2.7%. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 16.3, so investors are paying $16 for $1 of earnings. Price to sales is stock price over sales per share. They're at 0.9. They have a really good price to sales ratio. Price to book is stock price over book value per share. They're at 2.1. They also have a good price to book ratio. Interest coverage ratio is EBIT over interest expense. They're at 12.0, so they can easily cover their interest payments. ROE is net income over equity. They have a pretty good ROE at 13%. Current ratio is current assets over current liabilities. They have a good current ratio at 1.3. And it does look like the company's well capitalized. They had over $600 million of free cash flow, $1.9 billion of working capital, and a $300 million dividend payment. So they have $2.2 billion of funding. 1/3 of their current assets are accounts receivable. Then next is inventory. Then they have 56 billion Taiwanese dollars of cash. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 11 companies in the same industry as ASE. And if ASE has a number in green, they're better than the average. If they have a number in red, they're worse than the average. They're doing much better in all the price multiples. They do have a good current ratio. They're lower than average ROE at 13%, average is 22%. They're a lot higher in debt than the average, and they're a pretty small company relative to the average. And they do pay a higher dividend than the average at 1.8%, average is a little over 1%. So to summarize, I have them trading at a 25% discount, but this company seems to be doing good things within its field. Testing semiconductors is an important part of the process. They seem to be the leader in that part of the market. Their financials look really good, and they seem to be growing at a good rate. I rank their free cash flow 6 out of 10, their revenue 8 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.